Take a look at the world right now. The conflict in Ukraine is entering a new, unpredictable phase. Tensions over Taiwan are at a 30-year high. And we're seeing unprecedented geopolitical shifts in South America. If you feel a sense of panic about your financial future, you are not being dramatic, you are being rational. Most financial creators will tell you how to get rich in 2026. But after 20 years in institutional banking, I can tell you that is a dangerous advice. Chaos is not a discount, it is a filter. It filters out those with opinions and rewards those with mandates. This is the time to build absolute stability, not to gamble. Institutional investors, the family offices managing the wealth of the top 1%, they don't trade on hope. They execute an institutional operating system. They know that in 2026, with global growth slowing and inflation remaining sticky, the easy money era is dead. Today's plan. First, the mindset gap, retail versus institutional. Second, the 8% leak, finding guaranteed returns. Third, the 3-bucket architecture, safety through structure. Fourth, the haystack strategy, implementing core and satellite. And fifth, the broker filter, avoiding the no free lunch trap. Quick disclaimer, this is financial education and not investment advice. There is a massive psychological gap between retail investors and professionals managing billion-dollar portfolios. Retail investors are often addicted to the home run, obsessing over headlines of 60% returns in stocks like Nvidia. But institutional think in terms of generational wealth. Our mandate is built on one rule. Risk management comes first. We don't hunt for utopian gains, we secure risk-adjusted alpha. By prioritizing capital preservation and avoiding unforced errors, institutions consistently outperform the retail crowd over the long run. The irony is, the pros win because they focus on not losing. And the most common unforced error starts with ignoring the structural leaks in your own balance sheet. Before we talk about where to invest, we must address the leaks. In 2026, free money is a memory. Many US credit cards now charge well above 20%. In Europe, consumer loans are sitting at 7 to 8%. Here is the institutional math. Paying off a 7% loan is like earning a risk-free 7% before taxes. After taxes, this is still far more attractive than almost any safe investment on the planet. The S&P 500 might give you 10%, but that comes with 20% volatility. If you invest while holding high-interest debt, you are taking a leveraged bet on the market, just to break even. Institutions rarely accept high-cost leverage on their own balance sheet while taking equity risk on top. The rule: any debt above a 6 to 7% interest rate must be eliminated. Before you buy your first stock, use the debt avalanche method, paying off the highest interest rate first, to be mathematically efficient. The exception: if you have a mortgage at, let's say, 3%, in a world with 2% inflation, your real interest rate is only 1%. In this case, we keep the debt. That is low interest leverage. We'll let the capital work in the markets where the expected returns are higher. Now, to your investment capital. Institutions don't see money as one big pile. They use buckets. Bucket number 1. The emergency fund. This is about survival. You need 3 to 6 months of essential expenses in cash. In the US, surveys show 40% of adults can't cover a $400 emergency. Don't be one of them. In the Eurozone, park this in a 2.5% base rate account. Here's the secret. This bucket isn't just for emergencies. You may never need it really. It is for rationality. It prevents you for emotional and panic decisions when markets drop. Bucket 2. The liquidity strategy. This is for opportunity. For money you need in 1 to 3 years. It stays out of the stock market. We use money markets funds to capture that yield while keeping your dry powder ready for corrections. Bucket 3. The wealth machine. This is for growth. Only money you won't touch for 10 plus years. This bucket is protected by the first 2. You never sell bucket 3 because your car broke down. That's what bucket 1 is for. When it comes to the wealth machine, don't try to be a genius, because chances are you're not. The Spiver data is brutal. 94.8% of professional fund managers fail to beat the index over 10 years. If the pros with Bloomberg terminals can't win, why would you even try? When choosing your ETF, follow these institutional criteria. Fees. The total expense ratio should be below 0.22%. Breadth. it at least 2,500 companies. Liquidity, the fund size above 1 billion, and the method. It should be in physical replication. Two examples are the Vanguard FTSE All World, or on the other side, the SPDR MIC ACWI IMI. But those are only options. There are a ton of other ETFs that meet those criteria. The strategy: Core-Satellite. 80% goes into your Core World ETF. This is your foundation. The remaining 20% are your satellites, where you can chase higher returns in sectors like cybersecurity, emerging markets, AI, whatever you like to do, without risking your survival. And last but not least, the 2026 checklist for your broker and execution. A mandate is only as good as its execution. In 2026, the broker landscape shifted. First, the execution quality filter. Don't just look at the commission. Remember, there is no such thing as a free lunch. Regulators in the EU just banned payment for order flows, because free trades often cost more through wider price spreads. Always check if you're getting the best market price. Second, tax efficiency and reporting. This is where paperwork kills discipline. For the EU viewers, prioritize tax automation. Choose a broker that handles local requirements like our German Vorabpauschale automatically. International viewers, max out tax-advantaged wrappers like the ISA in the UK or Roth IRA in the US before using standard taxable accounts. Third, Tier 1 safety. Only use brokers that are regulated by top-tier regulators such as BaFin, SEC, FCA, or equivalent authorities in your jurisdiction. Your safe haven is only as safe as the institution holding your assets. To wrap it all up, geopolitical war, inflation, and high valuations. 2026 is not a year for amateurs, but is a year for opportunity for those with the system. Jack Bogle famously said, "Don't look for the needle in the haystack, just buy the haystack." Institutions have survived for decades following systems, not guesses. Now, you have the same blueprint. Eliminate debt, fill your buckets, buy the haystack, and please automate. Because boring is beautiful. And in 2026, your discipline is your only true alpha. Stay smart, stay skeptical.